is the weakness we saw this week an opportunity to get into this market? We bring in Villere Balanced Funds' George Young, Springer Financial Advisors' Keith Springer. Good to have you on the program, gentlemen. Thanks very much for being here. Let's talk about this rally, I guess, and whether or not you think it has legs. George, you want to be buying into this or selling into it?
You definitely want to be buying in this rally. We're long-term optimists. It's very important to own a preponderance of stocks. Stocks going to outperform bonds over the next year. Very important to own stocks.
What about some of the worries out there? Fiscal cliff, unemployment, slowdown in earnings?
Sure, those are all worries, but there's always worries. Can you ever think of a time where there hasn't been something to worry about? I think it's important to try and see through that, understand that people in this game are investors, they're not gamblers. And it's very important to be an investor and a long-term investor at that.
Keith, where are you on this? Weigh in.
Yeah, you don't want to be buying into this rally because Ben Bernanke is not going to come through with a QE3, and this is just a wish, a hope, and a prayer rally that we're going to get a QE3. There's no reason for him to do it. He's not going to do it to push the market to new highs. He's going to save it for a calamity, save it to protect us against Armageddon. He's going to continue to say, hey, it's going to come tomorrow, tomorrow, tomorrow. But there's going to be a pretty good correction when we don't get it next week or the week after.
Wow.
And so investors need to be careful.
Okay, so let's talk about that correction. If we don't get QE3 from Bernanke at the end of the month in Jackson Hole or at the September meeting, how sizable a decline would you expect?
Not huge, 3 to 5%, because it's going to take a little bit off the top, and that's the key. There's so much liquidity and there's so much negativity, it's going to prevent a big calamity, a big collapse. But it's going to pull enough down to make people nervous, to make people scared. So investors have to be careful. Do invest for need, not for greed here, and just not put all your eggs in one basket. Not go for the risk. Look for income and dividends. That's what we do for our clients. Just don't take all the risk if you don't need it. That's the key.
How much cash are you sitting on?
I've got not so much cash. I put cash to work in short-term instruments. I'm looking for bonds. I love income, dividends, MLPs. You're still finding 6, 7, 8% yields. You can find short-term corporates in place of cash. So there's a lot of places better than cash, but it's liquid money. If I need to put it elsewhere, I can. So that's the difference.
You've got the liquidity. George, what about that? What about the fact that it's the central bank situation that's really holding up this market, not necessarily fundamentals?
I don't disagree the market could go down 3% in the near term, but if I think that I can make 10% plus per year in stocks, I don't mind going down 3% if I can make that 10% long term. I agree completely that dividends are an important place to be. You can get 2% yield from the S&P right now. That's pretty attractive when you talk about the 10-year bond yielding 1.7%. There are great stocks out there that have a good yield, and I think investors need to look again for the long term. It's very important.
Does that change when taxes go up on dividends?
Sure, it does change a little bit, but think about it.
So it changes your strategy?
No, it changes slightly. Remember, with bonds, you're going to pay something like 30% in taxes. Right now, you're paying 15%. Let's say it goes up to 20%, 25%. You're still ahead of the game because, remember, dividends are based on what a company earns. That means the dividends will increase over time. A bond is fixed income. That means that what you get is fixed, and that means that it can go down in value. Be nervous about that.
We will leave it there. Gentlemen, great conversation. We appreciate your insights on this. Thanks so much.
Maria.
Thank you.
We'll see you soon.